Good day to all. My name is 𝗪𝘆𝘀, iFAST Research Analyst. In the ever-evolving landscape of the technology sector, we see a lot of potential ahead. We believe that the technology sector has already overcome an earnings recession and is now in the recovery phase. This transition is marked by not only higher sales and earnings growth, but also a remarkable uptick in profitability. Crucially, even in the face of a high interest rate environment, big tech companies showcase unparalleled resilience. Their robust balance sheets and substantial cash reserves shield them from market volatilities. Furthermore, the formidable competitive advantages and massive moats not only solidify their current market dominance, but also enable them to expand their brand influence and fend off competitors. Next, in the current digital age, the demand for cloud computing continues on its path of circular growth due to superior scalability and cost management, setting a trend that will continue to drive revenue and bolster their financial standing. Contrary to concerns that the rise of artificial intelligence might spell doom for big tech, we believe that these companies are uniquely poised to capitalize on the next phase of growth. Their considerable capital and top-tier talent pool position them not as victims, but as leaders in leveraging the opportunities presented by AI. Now, while some investors may be concerned about valuations, we contend that the potential upside from AI, coupled with other mega trends like cloud computing, has not been fully reflected in current stock prices. Therefore, we are upgrading the star rating for the digital economy from 2.5 stars neutral to 4 stars very attractive. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗪𝘃 will talk about US economy. Over to you, 𝗪𝘃.
Hi everyone, my name is 𝗪𝘃 and I'm with the research team at iFAST. So in the landscape of the US economy, a robust trajectory emerges, marked by a 5.2% expansion in GDP for the third quarter of 2023, following the second quarter's commendable growth of 2.1%. This impressive upswing is attributed to the powerhouse performance of strong consumer spending and robust business investment. Another crucial factor in shaping the economic landscape is the acceleration in fiscal spending, which not only has a direct impact on GDP, but also serves as a catalyst for private investment. So taken together, these factors reduces the likelihood of a broad-based US recession. Instead, we believe that the US is going through a rolling recession where different sectors experience a downturn on different occasions. Having weathered a recession in the past year, the tech sector is anticipated to spearhead the next phase of growth. The tailwinds of artificial intelligence and digitalization position the tech sector as a key driver of economic expansion. And within the tech sector itself, we like big tech stocks with strong balance sheets, dominant market positions, and wide economic moats. We also like semiconductors, given how the industry is a direct beneficiary of AI, which should lead to strong recovery in sales growth. Both big tech and semiconductors emerge as promising avenues, offering the prospect of robust earnings growth and multiple expansion. Finally, given how volatile markets are these days, a prudent investment strategy would be to focus on high-quality stocks. These stocks not only demonstrate resilience in a higher for longer interest rate environment, but they also exhibit long-term stability. The emphasis on quality ensures a steadfast performance, aligning with the principles of sustainable and enduring investment practices. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Dwight will share more about semiconductor bonds. Over to you, Dwight.
Hello everyone, this is Dwight from Global Fixed Income team. Today I will be sharing a bond investment opportunity on SGX. This issuer is the fourth largest semiconductor company in the world. Due to the impacts of the industry down cycle, this company recorded a massive loss last year, but it's expected that the share price decline narrowed to single digit starting from third quarter of last year and will increase by more than 10% in Q4. This is to say the industry down cycle is coming to an end. The sales of 𝗪𝘃 are picking up. Revenue in second quarter of 2023 punched by 47% year-over-year, but soared by 44% QoQ. Meanwhile, the EBITDA margin rose to 8.2% and the net loss margin narrowed by 10 percentage points to 41%. So we believe there will be ongoing improvement in the product price, and the company could be able to return to profitable position as early as the second quarter of 2024. From the perspective of credit profile, the litigate ratio was 41%, a 15 percentage points increase from the end of 2022, but is still below the industry average. Because of the large asset base and the robust development potential, Helix has ample room for further refinancing, and the funding gap could be easily closed. All in all, the credit profile of this issuer is at a decent level. For investor, Helix 226 USD bond has a yield to maturity of 6.5%. If we compare with other semiconductor bonds, most issuers have a flat yield curve with a bond yield of around 5% to 6%. So we think Helix is very attractive among the semiconductor companies. To get the full analysis, scan the QR code or click on the link in the description below. That wraps for the sharing of this week. Catch us again next week for more investment ideas and updates.